All right, let's get right into it. We've all seen those charts, right? On one hand, you have the public stock market, which zigs and zags like crazy, total chaos. And on the other, you have private equity, which just seems to be this smooth, calm line heading straight up. So what's the real story here? Are these two worlds completely separate? And this right here, this is the picture everyone has in their head, isn't it? On the left, it's the constant drama of public markets, up 1 minute, down the next. And on the right, you've got the image that private equity projects, just smooth, steady, predictable growth. I mean, it's an incredibly attractive picture, especially when the rest of the world feels so bumpy. But, as we're about to find out, that picture might not be the whole story. So that's the big question we're tackling today. Is private equity really the safe harbor it looks like when things get stormy? Or is there something else happening just below that perfectly calm surface? To figure that out, we have to start by understanding where that smoothness even comes from. So let's peel back the curtain on this smooth illusion. And the secret, well, it has this kind of dramatic name, volatility laundering. It sounds super technical, but the idea is actually pretty simple. All that choppiness and volatility from the public markets, it doesn't just vanish into thin air. It just gets smoothed out in the reporting. And it's all because of how and when these private assets get priced. And here it is. This is the absolute key difference. Public stocks are marked to market constantly. We're talking second by second. Their price is just whatever someone last paid for a share. But private equity assets, the actual companies they own, they only get a formal price tag put on them, maybe once a quarter, or sometimes only twice a year. You see, that simple difference in timing, that is the engine driving that whole smooth performance curve. So what does that infrequent pricing lead to? Well, it creates a lag, a really significant delay in how private equity reacts to big market shocks. It's not that it's immune, it just feels the pain on a totally different, much slower timeline. So let's walk through how this actually plays out step by step. First, boom, the public markets take a nosedive. For a little while, the private equity fund's official value, its net asset value, or NAV, might not move an inch. Then, when it finally does get revalued next quarter, the drop often looks way less scary. But, and this is a big but, reality always catches up. Eventually, private equity firms have to look at similar public companies to figure out what their private ones are worth. So a long-term downturn in public stocks will absolutely drag those private valuations down too. It's just delayed. But a company's value on paper is one thing. The real problem, the one that really hurts, is when a public market crash slams the door on the most important part of the private equity playbook, actually selling their companies to make a profit. And we see this super clearly with one of their main escape routes, the IPO. Think about it. When the market is freaking out, investors get scared. The last thing they want to do is bet on a brand new, unproven public company. So that IPO window, as they call it, just slams shut. Suddenly, a private equity fund's grand plan to take a company public is completely off the table. They're stuck holding on to it longer, or they have to find another way out that's probably not as profitable. Okay, so the IPO door is shut. What about just selling to another big company? Mergers and acquisitions, or M&A. Well, that door gets pretty sticky too. The big corporations that might have been buyers, they're hurting too. Their own stock price has probably fallen, which means it's worth less as a currency to buy other companies. And they probably have less cash lying around too. So the pool of potential buyers just shrinks dramatically. And the ripple effects just keep on coming. It's not just about getting money out of investments. A downturn also makes it way, way harder for private equity firms to get new money in for their next fund. And the reason for this is a really fascinating piece of portfolio math. It's called the denominator effect. Now, it sounds super technical, I know, but it's all about simple fractions. Imagine an investor's entire pot of money is the denominator. Well, when the public stock portion of their portfolio crashes, that whole denominator gets smaller. But because the private equity part hasn't been marked down yet, it suddenly looks like a much bigger piece of the overall pie. Let's make this super clear with an example. Picture a big investor, like a pension fund. We'll call them an LP. Let's say their goal is to have exactly 10% of their money in private equity. Before a crash, everything's great. It's all in balance. 60% in stocks, 10% in private equity. Perfect. But now, bam, the market crashes. Look what happens. That public equity slice gets way smaller, so the whole portfolio is now worth less. But the private equity value hasn't been updated yet, so it's now taking up 15% of the total pie. All of a sudden, that investor is over-allocated to private equity. And to fix that, what do they have to do? They have to stop putting new money into private equity funds, and that's the squeeze. So far, this sounds like a total disaster for private equity, right? Falling values, no way to sell, investors are pulling back. But here's the twist. This is where it gets really interesting. For a well-prepared private equity firm, a public market crash isn't just a threat, it's actually the biggest opportunity they'll get. It all comes down to one thing: having dry powder. This is what the industry calls all the billions of dollars that firms have already raised from investors but haven't actually spent yet. It's just a huge pile of cash sitting there, waiting for the perfect moment to strike. And this isn't some happy accident. The sources are really clear on this. It's a core part of the strategy. A market downturn is when private equity can do some of its absolute best work, using that dry powder to go shopping for bargains when everyone else is panicking and selling. And this is the classic move, the take private playbook. A really good, solid public company gets dragged down in a market panic, and suddenly its stock is on sale. A private equity fund with all that dry powder swoops in, buys up all the stock, and takes the company off the public exchange. This gives them the freedom to fix it up and make it better, far away from the pressure of Wall Street's quarterly reports. So at the end of the day, what's the big takeaway here? It's that private equity is absolutely not shielded from public market chaos. It feels the same pain: falling values, locked exits, nervous investors. The crucial difference is that it operates on a delayed timeline, and it has this unique ability to flip the script and turn that very same chaos into a massive buying opportunity. Which leaves us with one last thing to chew on. In a world that seems to get more and more volatile, is private equity's slow, delayed clock a fundamental flaw that just hides risk? Or is it a deliberate feature, one that actually allows for smarter, long-term decisions and lets them be greedy when others are fearful? It's a great question to think about.